Hi, everyone. Thank you so much for joining us here today. We are finishing the seven pillar series where we have this bonus pillar audits. We're calling it the eighth pillar. And today, before we go ahead and get started, I'm going to go over a few housekeeping items, and then Mike will take it from there. So first and foremost, if you are here for CPE credit, we do need you to do a couple things in order to receive that CPE credit. As poll questions pop up on your screen, you will have to answer those poll questions. If you have any issues with that, please let me know. I'll help you get it sorted out. You will also need to fill out the survey at the end of this webinar. You can do that fairly easily. It should pop up for you automatically as you are exiting. It will also be emailed to you in 24 hours. And if you do both of those things, we will get you your CPE credit within the next 48 business hours. So um, let me know again if you have issues with either of these things, but that's how you get your CPE. A couple other important things to note here as we're going along. If you have questions, please ask those questions. We are going to do our best to address them at the end of this webinar. So you can wiggle your mouse around, you'll see that Q&A button. Send those questions at any time that you have them during the webinar. And again, we're going to do our best to address them at the end of this webinar. I'm also going to be linking today's slides and handouts in the chat feature once we get the ball rolling here. They're also uploaded directly to Zoom and will be emailed to you in 24 hours. So there's a few ways to get your hands on those slides and handouts. And again, let me know if you have any issues. And now we can go to that next one there. A quick ad here for our webinars. If you like these live webinars, if you wish that you were doing them on your own time, we do have them pre-recorded with the pay option to get that CPE credit again on your own time. We have, I think, 10 or 11 options in there, all varying between 1 and 1.5 CPE credits. And those are available to you via the Salt Vault, which we have what comes with the Salt Vault listed here. You can also purchase those pre-recorded CPE credits one off. So if you have questions, again, as always, let me know. And now we can do some quick introductions here. So first of all, we are Sales Tax and More. We are a full service consulting and solutions firm. We have a really great team here of experienced tax professionals who are very dedicated to fulfilling your state tax and related needs. So we do a lot of sales tax returns, sales tax registrations, consultations, research, audit defense, exemption certificate management, and like our name states, more. So if you have questions about our services or you would like to work with us, please reach out. We'd love to hear from you and we would love to work with you as well. And a quick introduction to our founder, Michael Fleming. Mike's state tax knowledge is very well rounded and he has helped thousands of companies of all sizes and in all industries, and is especially well known for his work in the e-commerce industry. And Mike, if you want to take it from here, let's go ahead and get started.
All right, Ellie, thank you very much. Get my camera turned on. Okay. Well, thank you for that wonderful introduction and welcome everyone. Thank you for joining us today. We have a lot of information to cover. We're going to talk about audits a little bit in general. Then we're going to talk about the purpose of audits, how states choose companies, how states find companies that aren't registered, steps to take when you are notified that you are under audit. We're going to talk about some XYZ letters and explain what they are. We're going to talk about statute waivers. Auditors are often asking you to sign statute waivers. We're going to talk about the state processes or the states. Because each state is going to be a little bit different, we're going to be talking in generalities today. And these are the things, we're going to talk about the things that you should be doing in every audit, no matter which state it is, rather than going into the specifics of each state audit. We're going to talk about auditor requests, audit best practices. We're going to talk about what you should do after the audit, and then we're going to talk about some costly mistakes. Before we get started, though, Ellie, why don't we go into that first poll question?
Absolutely. That should be up on everyone's screen right now. We want to know if you came to our last webinar. It was not last week, but the week before, and it was the seventh pillar of a successful sales track strategy. If you couldn't make it, no big deal. We're happy to have you here today. And we hope that we have everyone in future webinars as we have them as well. So Mike, I'll leave this open for about 30 more seconds, but you can move forward and I'll close it out without you.
Okay. All right. So when we talk about audits, I don't know of any way to ensure that you're never going to be audited or that your clients are never going to be audited. However, you can have some great policies in place to avoid large assessments in that audit. You can also work on limiting your red flags that are going to that would increase your chance of being audited. So you can limit um, the possibility that you're going to get audited, but you can't avoid an audit altogether. So just keep that in mind as we go through this. All right, so if you're taking care of the first 7 pillars, that's this series of webinars that we've just done, you should have limited exposure if you are audited. You got to know what your Nexus footprint was. That was the first pillar. You got to register when appropriate with the correct type of registration. You got to know if what you sell is taxable, and when in doubt, tax. Source your sales correctly, charge the best rate that you can, have a use tax accrual system in place. You've got to be collecting, validating, and updating your certificates on all of your exempt sales, and make sure your returns balance, that all the tax you are collecting is remitted, and that you limit the red flags as much as possible. And I was involved in an audit just the other day, and I'm amazed sometimes at the lack of documentation that some people have. If you can't document something, it's like it never happened. So document, document, document. I can't say that enough. Some issues in an audit may have occurred 3 or 4 years in the past or even longer. And we find that despite someone thinking that, oh, I'll remember what happened here, they often do not. So you've got to document any types of issues out there, because what happens if the person who was doing all of this is no longer with the company and you have no documentation. So documentation is for you to help remind you about a situation, but it also proves to the auditor what's going on. And source documents are extremely important. Source documents are things like invoices, purchase orders, um, these are that the auditor is going to want to tie back. We had one audit the other day where someone was giving us spreadsheets and the auditor was like, hey, that's great, but I want to see the source documents. So you got to be able to get back to the source documents. Telling an auditor we don't know is usually not a great answer and can often have very negative outcomes. So it's all about the documentation, especially when it starts coming to certificates and things like that. All right, so the purpose of audits, um, to collect taxes. However, not every company can be audited. So most money that's collected for taxes is done through voluntary compliance. So in order to promote this voluntary compliance, you have the fear of an audit. So that's the big thing about audits. They want to make sure that companies are afraid enough of audits that they're gonna do all of these other things that they should be doing voluntarily, or air quotes voluntarily. So every once in a while, a state's going to make an example of someone because they have to have the fear out there. So um, that's the purpose of an audit there, to keep people honest, to make sure that everyone is doing everything that they should be doing. Raise money, instill a little bit of fear. So how do states find you? This is, primarily if you are tripping over my own feet here. This is primarily if you are not registered. So If you're selling on a business to business basis, one of the biggest ways that states find you is auditing your customers and or your vendors. Uh, Information sharing with other states. In the Southeast and the Midwest, there are groups of states that do share information. Uh, the IRS shares information with the states, other government agencies um, within the state level. You know, you may be registered for one type of tax and not another type of tax. If you're registered for the employment taxes, payroll taxes, then that usually tells the state that you have nexus there. And why are you not collecting their taxes? But that's one of the ways that you end up with this list. So leads can come from former employees, can come from competitors, they can come from customers, they can come from vendors. States are purchasing lead lists. Former employees, a lot of states actually pay bounties, a percentage of the money that they get from anyone that they turn in. So if you've got a disgruntled employee, not only can they get their pound of flesh, but they can get paid for doing it. And, it's not only former employees, I mean, spouses. If there's a spouse who knows something about sales tax, and I've seen, bad divorces happen and spouses get involved, and they're the ones who turn you in. Or business partners, someone feels like they got the short end of the stick and they're turning you in. Nowadays, your competitors. This has always been an issue, but a lot more since Wayfair because, we're looking at about 50% compliance. Last official survey I saw. Um, for economic nexus. And companies hear the footsteps. And people tell me all the time, Mike, I want to get registered, but we sell big ticket items and the sales tax is a lot. And our competitors are not charging sales tax. So we think we're going to lose a lot of sales if we start charging sales tax. On the smaller items, nowadays everyone charges tax. It's not as big an issue. But on the large ticket items, this is something that people are worried about. So the question we get asked is there some way I can tell on my competitors? Is there some way I can force them to be compliant? Well, you can't force them to be compliant, but there is a way to tell on them. All of the states pretty much have some way to report non-compliance. And as I mentioned, some states actually pay bounties for any of the tax they end up collecting as a result of the lead. Web surfing. Some states do this the old-fashioned way. They have auditors out there, manually looking. Other states use software called web crawlers, looking for certain terms that make it look like you're doing business in their state. Personal experience. I mean, auditors are people too. They go shopping. So you don't charge them sales tax or your client doesn't charge them sales tax. Next thing you know, you're a target for that auditor. Just watching TV or listening to the radio, auditors do that also. And I see these infomercials and, in this day and age, I don't know how some of these companies think they're going to get away with this. But they're announcing to the world, not only their potential customers, but the potential auditors too. Hey, we only charge sales tax in these states. Well, if you are advertising on TV, you probably have enough volume that you've crossed economic nexus in these states. So that's a big issue there. Articles in print or on the internet, auditors are looking at those. Stakeouts, they have trade days in Canton, Texas. It's a giant, the first Monday of every month, giant trade fair. And they have members of the Texas Comptroller's Office walking around to see who's charging sales tax and who's not. They have people at the border looking for trucks that are crossing in. Big case up in the state of Washington. People, it was a mattress company in the state of Oregon, and people would go to Oregon, not pay the sales tax, and then ask the Oregon company to deliver the mattress to their house. Well, the Oregon company had their name plastered all over the side of their trucks, and they were, these revenue agents are sitting on the border watching the trucks come in on a daily basis. And they were caught, and millions of dollars. They got put out of business. Big, big story going back 6, 7 years ago. Um, Industry listings, other registrations, applications, and permits. So these are just some of the ways that states find you if you're not registered. If you are registered, the ways you get chosen for audit, here's a couple of examples. For many companies, for small to medium-sized companies, it's a lottery. And it's a lottery you do not want to win. And some companies go their entire existence and never get audited. They're just lucky enough not to win this lottery. Other companies, not so much. And you never know when your number is going to come up. For the larger companies, the Coca-Colas of the world, it's going to be every 3 to 4 years, depending on what the state's audit cycle is. The statute of limitations usually are going to match what that audit cycle is. If you've got a lot of red flags, and we're going to talk about red flags later, you can become the target of an audit. Too many red flags, you're becoming, higher and higher on this state's radar. Asking for a refund. Unfortunately, states don't like giving back money, and asking for refunds will often generate an audit. Industry issues. If I've used this in one of the pillars there, the excuse that, well, the whole industry does it this way. Um, when a state finds that out, they're going to want to audit everyone. And this one example, it was the camera leasing company. They got audited by the state of Massachusetts, and they tried to use that example. We can't be doing it wrong. The whole industry does it this way. The state of Massachusetts says, well, give me the names of everyone in the industry. And they did. And Massachusetts followed up. The reason we found out about this is because one of the companies that was their competitor gave us a call and said, hey, can you believe that my competitor turned me in? And unfortunately, yeah, we believe that. In the state of Texas, it's a known issue that people who are building websites and doing website design, the state doesn't say that that's an enumerated service is taxable, but for the last 30 years, they've looked at that as data processing. So, a lot of um, advisors out there tell their clients, oh, you don't have to tax this. And it's not a listed service as taxable. They don't read the fine print. And the state knows this. So a lot of people get this wrong. So they target that industry. If you're in that industry, you have a much higher chance of getting audited. And when a state finds out, no matter how they find out that something's being done wrong in an industry, they target that industry. Informants, we've talked about that. Employees, competitors, customers, just like if you're not registered, if you are registered, if you're doing things wrong, these people can still tell on you. Personal experience, the auditors, just like if you're not registered, leads, just like you're not registered. When an auditor goes out there to audit you, they're not just looking at your sales to make sure that you're collecting the right amount of the tax and that all of the tax being collected is being remitted. They're looking at your purchases also. They want to make sure that, if your vendor didn't charge you tax and it was a taxable transaction, that tax is being paid. Maybe your vendor didn't have Nexus. That doesn't mean it's a tax-free transaction. It means that you're supposed to self-assess and remit it as a use tax. That generates a lead when the auditor's out there. Um, they can, some states, very formal. State of Texas has a lead card that needs to be filled out for every lead that is generated in the audit. Um, so Construction reports, we just talked about the auditor looking at your purchases for use tax reasons. Well, construction reports, you usually, buying a lot of things, and that can be a way that you're going to be chosen for audit, and previous audit assessments. If you've been audited previously and you were above a certain amount, the number used to be $10,000 here in Texas. I'm not sure what it is now, but that automatically puts you back on the list. They were coming out again. If a, I'm amazed at how many companies don't fix the errors. And, uh, you know, the auditors know this, so they keep going back to the well. When we talk about what to do after the audit, that's one of the things we're going to talk about. But if you've been audited previously and you had an assessment and it was a fairly large assessment, chances are the auditor's coming back. So you want to at least take care of what you were audited on the prior period. And Ellie, why don't we go to the next polling question?
Absolutely. We have a quick true or false question here. So there is no way to ensure that you'll never be audited. However, you can have some great policies in place to avoid large audit assessments. And your choices here are true, false, or it depends. And Mike, will let answers roll in? I want to remind everyone you do have to answer poll questions in order to receive CPE credit. And you can move forward, Mike, and we'll just again leave this open 30 more seconds or so and let people's answers roll in.
Okay. And just to reiterate here, you can't guarantee that you are not going to be audited or that your clients are not going to be audited, but you can limit the likelihood of them being audited and or limit the size of the assessment if they have good policies in place. All right, so let's talk about red flags a little bit. A red flag is an issue that draws attention to your account and increases the chance of an audit. Now, these are just a partial listing of red flags, but if you're making partial payments, the state sees that as a problem, especially, if you're doing it multiple times. A pattern of filing returns late, a pattern of paying the taxes late. You file your return, but you're making payments late. You're not doing those at the same time. A pattern of filing substantial amounts of exempt sales. Your returns not balancing to what the state expects, and then using the incorrect forms, the incorrect rates, uh, incorrectly applying credits, and forms being completed incorrectly. When you're doing this online, it's a lot harder to make some of these mistakes, but not impossible. It's the paper returns where a lot of this really, really shows up. But even when you're online, you can be using the incorrect forms. We see problems all the time. Someone's registered for out-of-state use tax, and they are utilizing Avalara, and somehow wires get crossed and they tell Avalara that they're filing use tax, and Avalara thinks it's consumer use tax. And this is, we've seen this happen multiple times. Avalara is filing $0 returns because they don't see any consumer use tax. They're the ones collecting the out-of-state use tax. They don't tell their customer. And now 2 or 3 years into it, this gets caught in an audit. Or the state catches on and says, hey, you're registered for this tax over here. You never filed a return. What's going on? And meanwhile, you've got $0 returns being remitted for a tax that you don't have any exposure to. So uh, just because something is being done online, or you think it's being handled doesn't mean that it is. So you got to make sure correct forms are being used, and that goes hand in hand with the correct types of tax are being registered, the correct types of tax are being filed. So these are all red flags which can increase the possibility of an audit. All right, so here's some initial steps to take when you're notified that you're going to be audited. Number one is assign a point person. Number two, review your pillars. Go over the 7 pillars that we've been talking about. See if you have any issues. Review your records. Any missing records you can request from either your vendors or your customers. If you've got certificate issues, you want to try to correct them and collect those prior to the auditor asking for them. That's called XYZ work, and we're going to talk about that in a little bit more depth. You want to review past audits if you've had any, and what the issues were in those past audits, and any protests you had if there were any. You want to consider a managed audit. If you know that you've got a problem and it's something that you just believe the auditor is going to see, there's no way around it, then you might want to ask for a managed audit. And if you haven't been in the previous webinars, a managed audit is when you do an audit yourself, or more likely hire someone like us to do the audit on your behalf under the supervision of the state. And the state, as a reward for not having to have their people take the time to do this, they're going to waive the penalty and some or all of the interest. So if you just know that there's going to be an issue and you're going to get caught, well, let's try a managed audit. It will reduce the penalty and interest. California has a great program out there. They reduce their penalty, waive their penalty and reduce the interest by 50%. So there are times when you want to consider this managed audit. You want to look for offsets. Are there any refunds or credits that you can put into this audit? You want to research the recent industry issues or court cases. What changes are out there? You want to review the statute of limitations. How long does the state have to go back? And you want to review what the auditor is requesting. Now, something else that we should do is inform our employees. Auditors, if it's an on-site audit, they're walking around, they're hearing conversations, and sometimes someone says something that the auditor hears, and next thing you know, the auditor's, trying to track it down. Sometimes they're digging in, going down the rabbit hole. Sometimes the auditor will stop and ask someone questions, probing, looking for information. You never want to volunteer information to an auditor. And, if you can, you don't want your employees really talking to them. You want them to, either yes, no answers if they are talking to them, or, hey, I'm sorry, that's outside my area of expertise. And, I just don't know. But you got to let your employees know that there's going to be an auditor on site. And it's not just, sales tax auditors. It's pretty much any type of audit. I've seen more companies get themselves in trouble by having, whoever the auditor is for whatever purpose, interacting with employees who don't know that they should be guarding what they're talking about. All right. So a little bit about the point person. Is the point person going to interact with the auditor directly, or are they going to be working through a third party, someone like ourselves who help companies defend themselves in audit? Do they have access to documents? And that's important too, because if they're working through an intermediary, when we talk about temperament, there's a buffer in there. If you're working directly with the auditor, that last bullet point on there about having the correct temperament, is very, very important. I mean, if you yell at us, we don't like being yelled at, but we understand. You yell at an auditor, they're not always as understanding. Auditors are people. We're going to talk about how you should treat auditors in a little bit here, but who's the point person going to be working with? Directly with the auditor, or are they going to be working through a third party? Um, does this point person have access to the documents? Do they have a basic knowledge of the company, what they do, how sales are generated? Um, do they have a basic understanding of the sales tax policy, sales tax issues out there? Do they have the time to devote to this? And then, we touched on this. Do they have the temperament? You got to have someone who can talk about facts over their emotions. You got to have someone who can talk about facts over their beliefs. There are a lot of things I believe, but the state doesn't care about that. If I'm going to make an argument, it's got to be based in fact. It can't be based on my belief. It can't be based on my emotions. Here's the facts. And you want to make any argument that you do make fact-based rather than emotion-based or belief-based. All right, so here were the 7 pillars of a successful sales tax strategy. It's the first one was nexus. The second one was taxability, rates, use tax, registrations, exemption and resale certificates, and then sales tax returns. Now, hopefully, you're not waiting for an audit to review or revisit these 7 pillars, but these are things you should be making a part of your ongoing strategy. And, you got to be doing a checkup, I think at least once a year, because even though you put a strategy in place, maybe it's not being followed. So the best strategies are not worth anything if they're not being followed. So at least an annual checkup, if not more frequently, to make sure that people are doing what they're supposed to be doing. I was involved in an audit of a company, and they got killed. It was the state of Texas. They got killed in exemption certificates. And this is before we got involved. And they told us about it. So um, they didn't want us to do the exemption certificate management. They just wanted us to help them when they had questions. So whenever they would ask us a question, we'd tell them, and we think they'd be learning of it, and they thought they were learning from it, and they thought they had this process down. And uh, they uh, they got killed in the audit, like I said. Um, so the next audit comes around, and now they think they have everything fixed. They got killed in the second audit for certificates also. So the third audit comes around, and when they tell me, I said, "Hey, the last 2 audits, you guys got killed on certificates. Do you want me to take a look at it before the auditor does?" And they said, "Well, we don't want you looking at everything, but can we do a sample?" And yeah, we do samples all the time. From a simple, we'll look at 25 certificates up to a more scientific sampling. Um, I looked at 25 certificates for them. 20 of the 25 certificates. This is the third time they got killed. They were going to be audited. They gotten killed for certificates in the 2 previous audits. And in this small sample, 20 out of 25 certificates would have been kicked by the auditor. So at that point, they said, "Okay, we give up. Help us." And we did some XYZ work with him, and we'll get to what the XYZ work is. But you've got to be making this a part of your strategy, and someone's got to be checking to make sure it's being done. These people thought that they were doing certificates correctly. Turns out they were not. So you don't want to wait to an audit to find out that you're doing something wrong. All right, so you got to review your records and documentation. So returns, all your returns with all the schedules and any amendments for the audit period. You should be familiar with that. Payments, you got to look for missing payments, partial payments, late payments. Look for certificates that support the exempt sales. You got to review your sales data for irregularities. You got to make sure your sales invoices are readily available. You got to make sure your contracts are readily available. The contractor is going to override an invoice. So if the auditor has questions about an invoice, they're going to ask for the contracts. So you got to make sure that they're readily available. And while we're on that, you want to make sure that the contracts actually say what you think they say when it comes to the sales tax. When I've talked about this before, when we do research, we not only ask for the invoices, we ask for the client to explain to us in their own words what they're selling, and how they're doing it. Then we ask for sample invoices and sample agreements because we want to make sure everyone's on the same page. And we often find that the description that they're telling us doesn't match the invoice, and the invoice doesn't match the contract. So they all should be lining up. I mean, you don't want to be in a situation where the auditor asks for something and they're scratching their head and saying, well, what's the correct way here? What are you actually selling? Because this this invoice is going to lead me down a certain path, or this contract is going to lead me down a certain path, and this is the way you should be doing it. It doesn't matter how you explain it. Documentation, documentation, documentation. If the auditor's reading the documentation, it's kind of hard to explain to them that, no, that's not actually the way that it works. So anyway, make sure your contracts are readily available. You got to review your use tax accruals, make sure the purchase invoices are available. You got to review your federal and state income tax returns. Auditors may often ask for those. Um, you got to review the business operations, request mission documentation from the vendors, customers, internal sources, and you got to be prepared to address any auditor questions. Now, we're involved in an audit right now, and um, this is Canada. Canada does not audit as frequently as US states audit. But when they do, boy, do they dig in. And documentation, documentation, documentation. And this client had actually defended themselves in a couple of audits. And the states didn't ask for this information. So when Canada was asking for it, they were, we were the intermediary. We're actually defending them in this audit. Um, but they were getting very upset. Well, the state of California never asked for this. Why is, Canada asking for this? Um, each state is going to be different. Each jurisdiction is going to be different. And sometimes they're going to be sticklers for you providing the correct documentation. It may be easy to get, it may be hard to get, but you're generally going to be better off providing them, doing the work to get them what they need. Because a lot of times, if you can't get them the documentation, they will say that you have inadequate internal controls, and you don't want to be slapped with that label. It does not set a good tone for the rest of the audit. And in some place like Canada, there's actually penalties for that. So additional penalties. So you want to make sure that you're working with those auditors and trying, even though it's going to take a little bit of time to get, and it's not easy to get, you want to try to get it. And because the flip side, if you don't, not only may you be subject to additional penalties and be slapped with the inadequate, uh, internal controls, um, they may also do an estimate. If you can't provide them numbers that they feel comfortable with, they may do an estimate. And estimates, if you're making up a number, which is what an estimate is, it's based sort of in fact, but it's still a made up number. If I'm making up a number, why not make up a really high number, especially if I'm the state? If I'm, a company defending myself and I'm making up a number, I want a made up lower number, but the state wants a made up higher number. So it's usually best to try to work with the auditor and provide the documentation that they're asking for, even if it's tough to get. Now, if it's non-existent, then we can talk to the auditor and say, hey, what type of alternative documentation can I provide you um, to support what you're asking for? And if you have a good reason for why it's not available, the auditor is going to usually work with you. All right, so sales or use tax is legally due only once. However, because states audit both buyers and sellers, it's possible that transactions can be taxed twice. And this happens not infrequently. I got a hard time for using that English there. Mike, why don't you just say it happens frequently? Because it doesn't happen frequently, but it's not infrequently. So transaction can be taxed twice. And, sometimes, you can say, well, the client paid that through an audit. Well, the state is not going to volunteer. They're not going to go check their records. A lot of the states say, well, hey, that's private information. I'm not allowed to look and see if this was paid through audit. I can't share information with you about this company. So you're going to have to be able to do the legwork for the auditor and prove to them that something was actually paid by your customer or by your vendor. So it's important to reach out to vendors and customers to see if they've already paid the tax. Now, when you're reaching out to your customers, the process of reaching out is often accomplished, which is what is sometimes called to an XYZ letter. And it's called an XYZ letter because California calls it an XYZ letter. They're the ones who have a formalized, XYZ letter and a process. And in the absence of a valid resale document at the time of an audit, the California auditor has the discretion to require and or allow. Sometimes you want to use this and the auditor will not allow it. So they've got the discretion there. They don't have to allow this and they can require it. It's what referred to as an XYZ letter. The actual form used is one of the CDTFA 504 series. Now, it's sent to the customers of a company being audited and requests that the results be sent back directly to the auditor. And if the auditor validates and accepts the document, then the seller is relieved of the burden of proving that the sale was not a sale at retail. And here's an example of that form. So you've got a couple of different options there, and you got to check the appropriate box. And so long as your customer checks one of these boxes and sends it back to the auditor is generally going to take it, and you are going to be relieved of um, the responsibility for having to have collected the sales tax or a certificate in lieu of the sales tax. Now, in states that aren't California, the states don't actually accept the XYZ letters. The XYZ letters are generally only acceptable in California. But the format, and I'll give you an example of one that we use here. The XYZ letters can still play a very important role because they can be used to collect the missing certificates. Information from the letter can often be used, sometimes with additional documentation, and it can be used to collect tax that was not on the original invoice. I mean, if you never collected tax and you should have, there's nothing to prevent you from going back and collecting the tax at a later date. Now, if you are dealing with the public, you're selling direct to the not a business, an individual, they're going to think that you're cheating them, and that's never going to work. But companies, this happens a lot, and sometimes they go about and ask for additional information. So, and it depends on the relationship with your customer. Are they an old customer? If they're not a current customer, hey, why not try to charge them for the tax? If they're an important customer, you think they're going to be offended, then maybe you eat it yourself. But um, it can be sent by you, or it can be sent by a third party like us. Now, here's an example of one we use, and this is customized for every client. And where it says client name, we fill out all the blanks in here, but it says, please indicate which of the following applies to sales made by your company. The first box, the items were purchased for resale. Enclosed is a completed resale certificate for these purchases. So again, we fill out the blanks. They're just going to check a box and do what the box says. Please contact us if a form is necessary. Company is an exempt entity, pretty much the same as the first one. Third one, the product was used in multiple states. We knew at the time of purchase that they would be used in multiple states. Encloses completed multiple points of use certificate. Not all states accept that. Company has been audited by the states in question. The items purchased were included in the sales and use tax audit, and use tax was assessed on the purchases. The audit period was. The items were purchased from for our own use and not for resale. And we self-assessed and paid directly to the state on our sales tax return in the following periods. And then none of the above applies. Some of our clients tell us, yeah, leave this off on these clients, put it on these clients. The items purchased were actually taxable transactions. Tax is applicable, has not yet been remitted. Please invoice our company for the tax due on these transactions. And the larger the company, they realize, hey, the state has your name. They see that you didn't pay tax. You're not working with the company, providing them documentation that the use tax was paid. Guess what? You're on a list. So you may be getting audited, but if you provide the company with the payment and the company shows that it was paid, you might not get on that list. So that's why the bigger companies are more likely to be working with you than some of the smaller companies out there. Smaller companies are like individuals. They think that you're trying to cheat them. Credits and refunds. Auditors don't automatically look for refunds. Most auditors consider credits the taxpayer's responsibility. So you should be reviewing your purchases to determine if you overpaid tax during the audit period. Deficiency interest is much higher than credit interest. So that's why we said you want to try to include any refunds or credits that you can in the audit. It'll save you money rather than doing it outside of the audit. Now, here's something I hear too. Well, Mike, we get audited all the time. The auditor comes in, they're gone in 10 minutes. That's actually a red flag, or could be a red flag, that there were a lot of credits or refunds, because if an auditor's there, auditors, this is the big secret. You're not supposed to say that auditors get paid on how much money they're raised, but yeah, that's a big part of their job performance. If you're going out and finding credits and refunds, and instead of collecting money, you're paying money, uh, that's not a good thing. So if an auditor, and they're supposed to be letting you know, by the way. So if they come in and they quickly see a lot of credits or refunds, they want to get out of there as quick as possible before they discover anything else. And so when an auditor's leaving quickly and telling you you don't owe any money, that's a red flag that you may want to be doing a refund review, or checking the items yourself to request a refund directly from the state. All right, so statute of limitations, a state can only audit a taxpayer for periods that have not exceeded the statute of limitations, which is generally 3 or 4 years, depending on the state. So a lot of times this will lead to an auditor, especially if the audit is dragging on, It's going to lead for the auditor requesting what's called a statute waiver, and it's for a set period of time. You generally, want to be signing this. A lot of people say, well, I'm not signing it. They should have gotten this done on time. Well, here's what happens if you don't sign it. The auditor's back is against the wall, and they just may include everything in the audit and issue an assessment. And it's a lot harder fighting an assessment than it is working with the auditor and keeping things off of the schedule. So we generally recommend signing the waiver and working with the auditor. It gets a little muddier when multiple waivers are involved. I mean, if the auditor's not doing their job and you've signed the first waiver and now they're coming with a second or a third or a fourth, um, you got to hold the auditor's feet to the fire after a while. But generally, the first time around, the auditors usually have the last laugh. So if you won't sign that waiver, it's not like you're going to get away with anything. All right, Ellie, why don't we go to that poll question?
Absolutely. And the hardest question of the day, are you going to join us for our next webinar? You can keep track of that by subscribing to our email list, following our social channels, checking our website. There's lots of ways to see it. And again, you do have to answer this poll question as well to receive CPE credit. Mike, why don't you carry forward and we can let this run out so people get a chance to answer.
Okay. So the state's process. An auditor is going to be assigned. The auditor is going to review your tax returns and documents, review previous audits and protests. You might see why we're saying that you should be doing this because the auditor is going to be doing this. They're going to be reviewing the timing for statute of limitations. Do they need to request a waiver? They're going to research the taxpayer. They're going to review recent court cases, rulings, industry issues, discuss known issues with the supervisors, and make contact with the taxpayer. Now, initial contact may be done by phone. Not all states do it. The call is going to be an introduction notification of audit. They're going to schedule a mutually agreeable start date. They're going to discuss the audit period and tax types, the statute of limitation issues, documents to be reviewed, and a confirmation letter will follow up. Some states skip that call and they just send the letter. Now, so no matter what, you should be getting a letter. It's either going to be a confirmation letter or an initial letter. All right, so the auditor may request chart of accounts, exempt sales, exempt documentation, fixed assets, expenses. I mean, the auditor can pretty much request anything that they feel is necessary, and it's what they feel is necessary to prove that tax is being collected and remitted correctly. Now, here's the document to avoid. And at the end of this section, I'm going to let you know. The one document to avoid providing to an auditor or at least providing the auditor up front. So auditors generally have the authority. We've just talked about this. Some taxpayers withhold documentation. Generally not a good strategy. If an auditor cannot determine from the documentation provided or feel that the documentation does not support a true and accurate picture, they're going to perform an estimate. And we already talked about how estimates are usually a lot higher. Auditors have a lot of influence, and while you don't need to be best friends with the auditor, we strongly suggest you have a good working relationship. You do not want to alienate your auditor. I mean, I hear people out there bragging, and when I talk to auditors, they have all sorts of horror stories. Oh, we were in Austin in the middle of August, and they put us out in a shed with no air conditioning. It was 110 degrees outside. Or up in Michigan in the winter. And people think that they're going to get the auditor out of there quickly, so therefore their auditor is going to go good. Audit is going to go good. No, it doesn't work that way. They're just going to, throw everything into the audit. So you don't want to alienate the auditor. They're going to have the last laugh. And they have a lot of influence on what can be done inside the audit. Use facts, not emotions, when communicating with the auditor. So the entrance conference, generally, historically at least, it's been in person. Since the pandemic, we've got more and more remote entrance conferences. They go over the scope of the audit, go over the business model and different processes, go over any issues with any documents, go through the report preparation process. So they're going to discuss pretty much everything. Important thing on here is that you discuss what your office hours are and your office policies. And even though you're providing the auditor with copies most of the time, you want to request copies of anything they're taking from the premises. Now, more and more, our clients don't want auditors at their place of business, and they ask us to request that it be done remotely. Um, when that's happening, we can do the entire entrance conference ourselves, or our clients can be on the call with us. Sampling, statistical sampling can be simple random sampling, random number generation, interval sampling. Um, there's lots of different types of sampling out there. What you basically want to do is evaluate the sample method because, once it's agreed to, it's difficult to change later on and impossible to get samples thrown out. Some states are going to be more formal process as to why something could be excluded from the sample or not. You want to know, are the samples representative of the population, or were there any extraordinary purchases or sales in there one time? And make sure how to address or treat credits or refunds. All right, so you want to respond to the auditor promptly whenever possible. You want to answer questions to the best of your ability. Don't assume the auditor is right or wrong. You want to ask questions if you don't understand. You want to ask for statutory documentation if you don't agree. Hey, can you give me something in writing that shows me what you're talking about? You want to work with the auditor to keep items off the schedule. You don't wait until the end of the audit to communicate, and don't be afraid to negotiate. So, if you're fighting the auditor on everything, you're telling the auditor they're wrong, and no one likes to be told they're wrong 100% of the time. So sometimes you have to give to get. So if you think that the auditor has made a valid point, don't fight them on it. Use that to get something else, and always keep calm. Now, after the audit, you want to have an exit conference with the auditor, potentially include their supervisor. You want to look, is your assessment, and review your assessment, was it fair? Is there any factual error? If there was a factual error, is it worth protesting or appealing? We have so many people who want to appeal because they just feel they're basing this on emotions rather than on facts. So you want to appeal, pay, or ask for a payment plan. And you want to ask for a penalty waiver because first time audit, generally going to get a penalty waiver. Now, this is really important here. You want to correct any deficiencies because there are going to be other states that follow. States share information. You don't want to be paying every state that comes along. Um, and not all states are going to come, but there may be one or two states that they share information with, and they're going to be back. So you don't want to be paying this over and over again. And Ellie, have we done 3 poll questions?
We've done 3 poll questions and we are at the top of the hour. So, Mike, I just want to say to everyone, and I don't see any questions at this time, but in case you have to roll out right now, thank you so much for coming and please watch out for the next webinar. Mike, anything else you want to add in before we close it out?
Um, Not at this point. Uh, so if anyone does have any questions, then just send them on over and we'll get them answered to the best of our ability. I appreciate everyone's time, and we hope to see you at the next webinar. Thank you.
We do. And Mike, you know what I want to say too? Mike and I have been we've been doing a lot of podcasts this year. We've had a podcast for a while, and there's been some really great episodes out. We've gotten some good feedback. So if you haven't already, check out the podcast. If you're dying to hear mine and Mike's voices more, you can listen to us in your car on the way home. So thank you again. And that's all I wanted to add in here, Mike.
Yeah, well, if you're um, in South Carolina, we'll actually be at the South Carolina CPA conference. Is it next week? I think it's the end of next week, is it not?
Yes, it is.
Yeah, so we'll be speaking 2 days there. So if you're in South Carolina and you're actually part of the conference or a CPA and would like to join the conference, come visit us in person. We'd love to meet you. Bye-bye, everyone.